Hello and welcome everyone to the 9th edition of Standard Chartered Wealth Masterclass. That short video was to set the context for this webinar, something that we've been having from the May of 2023. We are well into the 9th edition. Our endeavor in these Wealth Masterclass is to ensure that we reach out to our investors and prospective investors and share demystify key investment concepts, share market updates, and provide actionable inputs to everyone. To do this, what we do is we get an industry veteran and we pick a topic that is more topical and makes sense in the current environment. The topic for today is how to position your investments to navigate 2024. There's a lot of information floating. There are mixed news that we are getting. And now how to make sense of that, how to cut through the noise, and how to position your investments is very important. And to help us through with that, we have a very special guest today, Mr. Suresh Soni. Mr. Soni is a seasoned asset management professional with rich experience of over 27 years. His career expands across investment and business management. He has varied experience of working with startups as well as global giants, across retail as well as institutional clients. Currently, in his current assignment, Mr. Soni is the CEO of Baroda BNP Paribas Asset Management India Private Limited. Prior to joining Baroda BNP Asset Management, he has worked for over 15 years at Deutsche Asset Management, leading it to become the most successful foreign bank promoter manager in the country. He was also the CEO at Edelweiss Alternative Asset Advisors, one of the largest alternative asset managers in the country. Welcome to our Wealth Masterclass, Mr. Soni.
Delighted to be here, Ravi, and thank you so much for this opportunity.
Well, so without further ado, we've had a couple of minutes of delayed start. As I said, a lot of information has been floating. We started the year on a slightly more optimistic tone because Q4 was quite bullish for risk assets, and so was it for fixed income assets globally. But since then, a lot of things have changed. People have different opinions. Now, please take us through how to position our investments for the rest of 2024.
Sure. So, Ravi, I think this is a fantastic opportunity to be discussing this with you and all your clients. So, delighted to be with you. Indeed, right now, if you really think about around us, there are multitudes of narrative. One which says that it's India's Amrit Kal, or the other one which says, are the markets too high, or have I missed the bus? So I think there are, between the two, somewhere there's probably a truth. And what we will try to do is try and establish some part of it, and at least have a healthy debate about where we think the markets are, and whether we should really get excited about 25 years journey right today. Is it too high, or is it a great market to be invested in? So let me kind of just go on and give a bit of a context setting as to where do we stand. So before you really want to chart about where we are going in this world, what you want to understand is where do we stand today? And on that, fairly simple. If you really looked at it about beginning of last year, or over the last 18 months, I think following COVID, there has been a lot of monetary expansion that the entire world has seen. What the Western central banks did, and was virtually followed by everybody, was that as COVID happened, economic activity came to a grinding halt. The interest rates were brought down in an emergency measure, and also government started spending a lot. This was to cushion the shock impact of COVID. Now, in the aftermath of that, we had seen unprecedented level of inflation globally. UK had more than 10% inflation. US was again close to double-digit inflation, about 8-9% inflation. And that actually led to a significant monetary policy tightening in the world, following which, by end of the calendar year last year or early part of this year, we find that inflation has actually miraculously come under control. And the inflation number in US are close to about 3%, UK are about close to 4%. I think they're still higher than the tolerance zone of the central bank, but they're significantly lower than what it was about a year back. Now, alongside that, the growth actually has held up relatively okay last year, which was again a bit of surprise because most people expected due to a lagged impact of the monetary tightening, the growth globally would come down, but in fact it held up relatively okay. This year we would expect the global growth to go down a bit. The world growth from about 3.5% in 2022, this year should go down to about 2.7, 2.9%. And within that, while there are not very, let's say, active talk about recession, but most of the economies, including US, would slow down significantly compared to where they were last year. Now that's the background. So basically, background is that of a world where growth is slowing down. Background is that of a world where probably the central banks will start easing the interest rates. So it is expected that Fed would start cutting the rates sometime in about May thereabout, and that should lead to a rate cut cycle all over the world. So where do we stand as a country at this point of time? The title, of course, is Oasis in the Desert, but let us try and examine the data and see whether things really stand out and whether it really kind of the data justifies the optimism. So one thing which absolutely stands out for India is that India is no longer a small country which people can afford to ignore. As a country, we are now fifth largest economy. And just to context, sometime in calendar 2005, we used to be 13th largest economy. We were not even the top 10 then. From there on, over the next 18 years, from calendar year 2005 till calendar year 2023, we have moved from 13th largest economy to 5th largest economy. And as we speak now, going by the current rate, sometime in calendar year 27, we should become the 3rd largest economy in the world. So what you see here on the table on the left corner is essentially the way the ranking of the country has moved over the last 18 to 20 years. Calendar year 2005, we were 13th largest economy in the world. And at this point of time, as we speak, of course, all of you know about it, we are 5th largest economy in the world. That's a huge jump in where we used to stand then. No other country would actually come anywhere close to the change that India has seen over this period. In fact, if you really look at it, China at the start was 6th largest economy, it is 2nd largest. So that's a significant move too, but India has in fact, from the number of ranks that it has jumped out, taken over everybody else. And in the next couple of years, we should be ahead of Germany and Japan, and which makes us 3rd largest economy by calendar year 2027. Now, when you become that larger market and about $4 trillion plus market cap, which again makes you 4th largest equity market in the world already, it becomes impossible for foreigners to ignore you. It becomes impossible for the global economy, global markets to ignore you. And which is why you actually see, when you think about it, India's weight in the foreign policy, India's weight in the foreign investors, or India's share of voice in the global market, or the number of MNCs which are coming to the country. All of that is aligning because the country has now started reaching that stature where this becomes difficult to ignore. So it becomes difficult to ignore for the policymaker, for the governments, for the foreign governments, as well as the foreign portfolio investors. Now, the other thing that actually India has done, and which is why for the portfolio managers it becomes very difficult to ignore, is that India has consistently delivered returns over the last 5, 10, 15, 20, 30 years. In fact, this is one market which has compounded the investor's wealth at about 10% to 12% dollar return over the last 25 years. This makes it either the best performing market or the second best performing market, pretty much in line with what United States has done. So one, I think it's a large market, it's growing quite fast, and also it is a market which has delivered return to the equity. One more thing that I would want you to focus on here is the 1-year return. If you really look at 1 year column here, the last year in the calendar year 23, the dollar returns from the world equity market was 24%. US in fact did 27% return. So if we really feel that India is overheated with about 20% growth last year, so if you really look at Indian market returns over the last calendar year, the returns were about 21% in dollar terms or 24% in rupee terms. In fact, India does not even come in the top performing equity market globally. It is probably lesser than the world average in terms of the return last year. So while if there are pockets where there can be excessive optimism, I think on an average, the market has kind of maintained its sanity. So the bigger message here is India has been one of the best performing equity market over a period of time. It's also a large economy. Now, one thing that I just want us to focus on, and we always talk about India is the fastest growing economy, which it has been last year, year before that, and in the current year we should be the fastest growing economy. But how do the stock market returns correlate to the growth? Essentially, there are three parts to it, and I just want all of us to focus on three key components here. When we talk about growth, it does not only mean the GDP growth for 1 year or absolute growth, but it actually means the durability of the growth. So if you're growing, let's say 3% in a year and 10% next year and then -2, on an average you may have a decent growth, but you don't have a durable growth, then the market is not going to pay a premium to it, or investors are not going to like it. What investors like to see is a consistent, stable, durable growth. So what is the growth rate? How durable that you think, for how long that growth can last is equally important, which in turn is actually determined by the second factor that I've written here, which is resilience. How resilient is your economy? One of the things that we have seen over the last 20, 30 years is countries go through different issues. There are times when in some of the Latin countries you are seeing huge inflation bouts, you are seeing currency weaknesses, and that suddenly derails and takes away all the returns that you have made in the market. But what is interesting about our country, and I'll come to that dimension, is that not only the growth is good, it's also durable, it's also shown remarkable macro stability. And finally, while the economy may grow, for companies to make money, what you really need is that, is the growth happening in a manner that there is a return on capital getting generated by it? Is there a profitability getting generated by it? So three parts to it: growth, durability of the growth, and profitability of that growth. Those are the three key determinants which lead to equity market performance. Now, how does India stand on that? So in India, in fact, the resilience is something that kind of stands out about this market for simple reason that about 60% of our growth essentially comes from consumption. So we are a largely domestic driven economy, which is very different than, let's say, what China's model was or what Southeast Asia was, which was a lot more export led and therefore too much dependent on international markets or the commodity price movement. So what makes India's growth durable is the significant dependence on the local market or local audience. The other two things that actually work for the country is because it is a democracy, there is a certain amount of political or policy stability that we are able to achieve. And finally, we are a country with about 28 years of median age, which is where probably China was about 20 years back, which essentially leads to a lot more aspirational growth. So a 28-year-old is thinking about buying his car, buying his house, and therefore a lot more consumption. So that's as far as the durability of growth is concerned. But when you look at the stability indicator of the country, I think we do quite well as a country on foreign exchange dimension. Our covers, in fact, we are probably one of the very few countries in the world where our foreign currency reserves are higher than the entire external debt obligation of the country. There will not be any other country among the larger economy that I can think of which has got so much of cover. And that gives you foreign exchange stability as well. And over the last about 20 years, our forex reserves have grown more than 10 times. That gives rupee the stability, and therefore the dollar returns for the investors tend to be pretty interesting. And finally, this is the first time in my career that I've seen Indian inflation in 22-23 being lower than US inflation. So after Indian government implemented the monetary framework which targets inflation from 2014 onwards, our inflation has been decisively lower. So we've got a strength of growth which is coming largely from domestic side, as well as we have got very stable macro backdrop. And that in turn is leading to strong continued growth in the country, which you find in almost all the high frequency indicators, whether you look at GST collection, whether you look at automobile sales, whether you look at the hotels around you or the marriages that you might be attending. I think you see that pattern of consumption booming in the country pretty much around you. I just want to spend a minute on this slide. This is an important one where essentially, if you really look at it, for India, the equation has been relatively simple. Nominal GDP growth leads to corporate top line growth, which leads to profitability growth, and that is what leads to equity market. If I very simply try to put it, over the last, let's say, 20-30 years, the nominal GDP of this country has grown at about 11%. So you get about 7% GDP growth, let's say 6% GDP, 5% inflation, 11% is the nominal GDP growth. Corporate turnover has generally grown at around 12 to 13%, and profitability of the companies have grown at about 15%. Now that is precisely the return that you got in the equity market. So equity market effectively just deliver you the return coming around on the growth of the broad economy, which translates to the turnover of the companies increasing, and that leads to the profitability. So that equation has worked well in India. That equation continues to function. Now going forward, again, if our thesis is that India is going to grow at about 7% with 4% inflation, then your equity market return expectation can be somewhere between 12 to 15% zone over a long period of time. And I think there may be some small leads and lag here, but that is how the equity generally tends to behave. Now, when you get growth which is consistently coming, that leads to an EPS growth in the company's reported earning, which in turn leads to the market growth. Of course, there may be small leads and lags which will happen in the market, but from a broader longer term perspective, that's how it tends to happen. Now, again, if you really look at it from a EPS growth perspective, because that is what should matter to the investors, and that's where I want to spend a moment. Globally, the EPS growth rate of the global companies on an average has been about 4% over the last 5 years. And most market would probably be lower than that. China has actually degrown. It's earning at 2% per annum. And that's why Chinese market has tended to underperform significantly. So while in China, the economy has grown, somewhere it has not translated into the profits for the corporations. Why does that happen? Because a large part of the Chinese economy is owned by state-owned enterprises, and profitability is not necessarily the key driver there. In India, a large part of the economy or large part of the market is driven by private sector corporate, and profitability is the motive. Even for public sector corporates, there is a very clear MOU that they sign with Government of India where they have clear profitability target. So the profitability target in the country is very clearly embedded in the corporate culture, and which is why in India continually, as you see economy growing, the profitability also grows. So India again stacks up quite well compared to the world in terms of the EPS growth over the last 5 years, and we would again see it similarly in the coming time.
If I may, stop you for a moment, and maybe, I had a question. See, our analysis has been that post-COVID, post the initial shock of the COVID, the earnings trajectory in India has been quite different from what it was before the pandemic. So let's say 2011 to about 2019 or 20, and then the one you had from fiscal 21 till 24, which is going on. I think there's a market change. Would you want to highlight what the change is?
Yeah, sure enough. I think that's a very good point. From 2011 to 2019, the earnings grew at about 7% CAGR. And what is happening, in fact, is interestingly from 2020 onwards, after the, let's say, bottom of the two, COVID, and or even if I remove that, from 2019 till now, the earnings have grown in double digit. Right now, we are growing at about 15%. So what has really happened over the last 10 years? And again, I'll try and give you a slightly longer term perspective. You see, for earnings are never birthright. Sometimes in the economies, we tend to believe that we have been growing at 6%, so we'll continue to grow. It doesn't happen that way. We need to keep reforming the economy in order to get earnings. Normally, whenever you do reforms, the initial part of the period tends to be painful, but it creates a better capacity for long term. So if you look at it from 2014 to 17-18, we had a slew of reforms. You had introduction of bankruptcy code, you had the introduction of GST, you had demonetization, you had a RERA. So there are a number of legislation which came into place. All of them were aimed at creating the productive capacity of the economy better, but at the same time there was a near-term impact of that where the market took some time to adjust. So that's been one factor. The second factor has been that over a period of time, I think what we had gone through in between 2010 to 2020 also broadly was a period where emerging market in general had ended up underperforming. That was also a period where US was one of the best performing market. And these are decadal trends which keep changing. In fact, current decade is actually working well for the emerging market, and our belief is that emerging market will tend to do well. So between 2010 to 2019, the corporate earnings had actually bottomed out at about 2% of the GDP. Now they've grown back to about 4%. The peak in 2007 was about 7 to 8% of the GDP. So we're somewhere in the earning improvement trajectory, but not at anywhere close to the peak. Thank you. So again, I think the earning growth for India over the last 5 years, despite COVID shock, was 11%. At this point of time, as we speak, we are estimating the current year earning growth to be at around 16%, as well as coming 2 years to be more than 15%. Now, these are pretty impressive numbers in terms of the corporate profitability. As earnings keep growing, normally you'll expect the stock market to kind of perform in line, of course, with some amount of leads. And therefore, it's no surprise that most of the global leaders today are queuing up to India and have a lot more investment interest in this country, in this economy, and would like to certainly have a much longer term play. So not a week goes by when a global leader is not in India and talking about his plan for the future. Well, this was all about story about earning, how's the economy, but the question which we still need to answer is the market overvalued? The reality is that last year we have seen markets kind of performing about 20-22% as far as large cap is concerned, but when you went into small cap kind of segments, the market is probably going up by about 45-50%. So are we into a bubble? Is the market overvalued? How does it stack up? So if I take 5-year dimension, we are probably a little below average, but if I extend the time horizon to 10 to 15 years and allow me a moment to do that, we are trading slightly above our long-term average PE ratio. So our long-term average PE ratio on MSCI has been about 18.5, 19. Today we are at 21. But then again, I think one thing that one has to notice is that over a period of time, as Indian economy comes of size, we have generally seen the PE ratios for this economy tending upwards, because as you become more predictable, as you become more resilient economy, the risk premium that investors are demanding for India comes down a little bit. And therefore, over a period of time, PE ratios would have a natural tendency for this market to rise. So we are trading, let's say, about 5-10% higher than the long-term average. The market is not cheap anymore, but it's a fair value zone. Earnings are looking good. The flows in the market, and again, let's spend a moment on that. Flows in the market or allocation in the market, frankly, if I look at foreign allocation, foreigners are under-allocated to India. Sometime in 2018, foreigners used to own about 22% of Indian equities. Today, they own less than 18%. And in fact, I can tell you from my personal experience, because I keep talking to our BNP Paribas global folks about India appetite, and we have an India equity fund which we run out of India. It's a Luxembourg-based fund. We are seeing a lot of interest there from foreigners to invest in that. Domestic investors again have started investing fairly regularly, and it's amazing that SIP, which is essentially probably a single program of its kind globally, where there are no tax incentive, where there are no compulsory investment limits. So unlike 401k, there was in US where there was tax incentive, or saving plans in Singapore, let's say, where there are again government mandated saving or superannuation plan in Australia. In India, in fact, the entire SIP program is voluntary without any tax benefit, but investors are putting in more than $2 billion every month. So that gives you a lot of resilience, incremental appetite from foreigners. I think that makes the flow situation fairly attractive. And embedded earning growth in India, which is now looking like about 15%. I think the markets are reasonably poised. Having said that, let me tell you a couple of points, however. There are pockets of excesses in the market. Let me be very transparent here and let us be watchful for it. What are the pockets of excesses? Well, for example, in India, I think options volumes are by far off the chart. Option volumes have actually grown at an unprecedented pace in the country, and today country would have one of the highest option volume of any large market in the world. And that has in turn forced SEBI to come out with a warning where they are saying that 90% of the option traders lose money. It has to be a warning that is shown to every stock market investor before they enter into an option trade. So that's where one sees excesses. One sees excesses in some small pockets of SME exchange, which is where I think the index of SME exchange has grown some 22 times in the last 2 years. Or there are some areas where in small pockets or in some specific themes there can be excessive optimism. But on the whole, on an average, the market is fairly decent. There are enough pickings available in the country. And the good part about India is that we are a very large diversified market. Unlike US, where there are 6 technology companies which represent about 70% of all the stock market return of last year. In India, you have a very diversified market and there's enough to choose. The market on the whole slightly above average, but not looking like something which is out of bound with the current reality. Again, market valuations are not a single number. It's not an exact science. It's an approximation where you try to get a sense. Our belief is broadly the valuations are acceptable, reasonable. Investor can still make allocations into the market. But do stay away from certain areas where there is an excessive optimism. So what are we saying about the market? I think we are saying that large cap is broadly in line with historical average plus minus 5%. Mid cap is 20% premium to historical average, and small cap is at 35% premium to historical average valuation. So those are the areas where you have to be a little careful if you are trying to time it in a short-term perspective. However, if you are looking at a 5-year, 10-year investment, I think you can still make allocations there, because reality is that in any economy, mid cap and small cap would tend to grow faster than the large caps. However, you have to be also mindful that they tend to be a little more volatile. From a valuation standpoint, we would prefer large caps today. I do think that you should consider that category a little more over small caps. Among the sectors, I think a lot more constructive about the locally led sector because domestic demand situation tends to be strong. We are generally working on a triple C framework, as I would call it. One C stands for capital goods, second C stands for consumer goods, consumer, especially discretionary consumer, and the third one essentially tends to be more in credit and capital market area. So those are the themes on which we are quite constructive. Couple of other things that I would want to point out is I think balance advantage could be another category which could be interesting because of the fact that this is a category which actually tends to do well over a period of time, more on a risk-adjusted basis. And today it looks particularly interesting because while equity is looking decent, fixed income is also looking attractive, and I'll spend a moment on that just to kind of buttress that point. But I do think both assets are reasonably well poised. So balance advantage funds, again, which actively allocate could be an interesting place. And of course, there's an interesting product category, arbitrage, which has emerged now, which is a fixed income variant with tax benefit. Just taking a couple of minutes on how to go about stock selection. Some of you would be investing in your own right. We as fund management house essentially follow a philosophy called BMV, which is business management valuation. Very simply put, I think when you're looking at any stock, these are the three pillars on which one should be focused, which is business. What is the business underwriting? How's the growth of the business? How durable the growth is? And what is the moat or positive change you are seeing? Second, valuation. Is it available at a reasonable valuation? Because you can't really overpay for stocks in the market. And thirdly, of course, is the management aligned with minority shareholders, or it is a management that you can't trust, either from the execution or from a corporate governance perspective. So business management valuation, this is a very important screen. In fact, this screen actually acts both as an elimination work for us as well as something where it helps in selection. So unless a stock qualifies on all three parameters, it does not even come in our consideration set. So it can be a good business at a reasonable valuation, but if the management is bad, then you can't. So a single factor out of this, you getting a negative mark gets you out. So that's just in terms of equity investment philosophy. One moment on the fixed income side, as I promised you that I'll cover that a little bit. So basically in India, whenever the interest rate cycle has moved, our typical movement in a cycle tends to be 250 basis point or thereabout. It can be 200 sometimes, it can be 350 sometimes, but 250 or thereabout is a typical length of the cycle. In this cycle, from bottom, we have come up to 150 basis point. We believe we are at the peak of the rate cycle. And at some point of time, RBI will start loosening the purse strings and rate cut will begin sometime later half of the year. As and when that happens, it will be a gradual decline in the rates over a period of time, but typically the past few cycles have been about 200 basis. That's just to give an indication. What does it mean to us? What we would say is that this means that you can make some allocation to duration products in anticipation of the rate cut. So you don't have, over the last 2-3 years, we have generally not put much allocations to duration products, but this could well be the time to think about. Finally,
Suresh, you were on the previous slide. Yeah, on the previous slide, a very interesting point that comes across. You mentioned about India or the Reserve Bank of India implementing the inflation targeting framework because of the problem that we saw in 2013 and 14. This chart, in fact, clearly brings about that point that sequentially over the last 12-13 years, bond yields, inflation, 1-year rate, 10-year Indian government bond yield, all have sort of declined in sequence. Which also is because of the efficacy that RBI and the government have together bought in. But what does it mean about fixed income yields, absolute yields sustaining over the near future? Let's say over the next 3 to 5 years, do you see a downtrend continuing? And in that context, the current absolute yields, which are still attractive, how do you see that as an opportunity?
Very good point, Ravi. So again, I think if you really look at this chart, if you look at pre-2014, the 10-year yields would have probably touched 9% sometime in 2013-14. And post that, you probably would not have seen it crossing 8% any time, more likely 7.5%, and average would have probably been about 6, 7. So this chart is actually can be divided into two parts there. Post-inflation targeting framework, in fact, India has managed to achieve average inflations of about 5% compared to average inflation of around 8 to 10% that we had in the decade prior to 2014. So if you really looked at inflation trajectory from 2003 to about 2013-14, the average will come to something like around 8 to 9%, with some peaks being around 12-13%. So there was a lot of volatility that you used to see in inflation earlier. Now, what you see lately in the last about 9 years or thereabouts is the inflation targeting framework is that inflation has generally been much more smoother. It has been in a tight range, and Reserve Bank of India has responded very swiftly to any inflation change. Now, two things are happening. Because you are now stable, the government is also a little more confident, and the world is a lot more confident, which is why JP Morgan is now coming to include Indian bonds in its index. JP Morgan bond inclusion itself leads to an inflow in the country of about $25 billion. There's another one which will happen by Bloomberg sometime down the line, which could mean another $15-20 billion. So not only is Indian bond market becoming more stable, inflation becoming more predictable, but also we are getting a new set of investors who are going to put in incremental money. This is the first time infusion, and therefore this will be an immediate flow. My belief is all of these factors will lead to some decline in rates. We are at 7%, 7.10 right now on the 10-year. Currently, I think this current level does factor in some amount of expectation of a rate cut. So I would expect the 10-year to settle down somewhere between 5.5% to 6% over a trajectory of maybe next 3 to 5 years. And rate cuts in this cycle, while the rate hikes have been very rapid. So if you really looked at this chart, you find the rate hikes have been 50 or 75 basis points at one go. The country. However, on the decline, RBI will do 25 basis point probably at one point of time, and then watch it, then do 25. So it will be a gradual decline in the rates over a spaced out period, and therefore gains would come, but it will not be front loaded, but it will be a gradual thing. So if you're looking at fixed income allocation and you make allocation into, let's say, duration products, which could be corporate bond, could be gilt, could be short maturity fund, which run maturity anywhere between 2.5 years to up to 5-10 years. The return you will make is about 7% or thereabout on accrual. In addition to that, you'll probably make about 1.5 year on a sustainable basis over the next 2-3 years by way of capital gains. So you could actually end up making somewhere between 8 to 9.5% return, with some amount of interest rate cut expectations over the next 3 years thereabout. So what are the risks to it? I think when we talk about investment, we talk about some risk as well. I think 2-3 points. One, of course, is that commodity, India tends to be net importer of oil. So we assume that oil will probably stay below 100 despite the geopolitical, because right now the world is going through the highest amount of hot wars and cold wars that you have seen any time in the last 20 years. And despite that, oil has been reasonably well behaved. I think at the current level, we are quite comfortable. Up to 100, we are quite comfortable. But if oil goes very sharply higher for a sustained period, then it could pose some amount of risk. Otherwise, I think moderating rates is a positive for the country. Global growth rate outlook. If there's a recession in China, recession in US, or some of those factors, then of course it could impact the entire global equity market and therefore could impact us as well. The other parts, of course, which are peculiar about this year is that there are elections all over the world. There are more than 40 nations where elections are happening. Notable is, of course, India, US, UK later in the year. And any major policy reversal there could probably mean some amount of, let's say, readjustment for the market. Geopolitics, as I said, Cold War and Hot War Both are there right now on the plate. The big risk for world could be China's invasion of Taiwan or any of those things I think could create some short-term negative headlines. China is of course slowing down. I think part of it is positive for India because some amount of equity flows are coming to India. Some amount of production is also coming to India. But at the same time, I think if they do something belligerent there, or if it does some serious impact on the commodity prices one way or the other, that could probably be a risk for the market. So I want to pause here, and I'm more than happy to take any questions that you may have or the audience may.
Sure. So in fact, first of all, thanks a lot for taking us through the detailed presentation. It was quite exhaustive, and in fact, a lot of these questions that we have on the chat box have to a great extent been addressed. But there are, say we have over 40 questions, as I see. Before I get to the question, I may want to attempt to summarize what the presentation was all about. It covered India's current position in the global context, how global investors are looking at India, the drivers of opportunities, the stability, what has led to the stability, the political reforms, the work that RBI has done, how the macroeconomic stability indicators are panning out for the next couple of years, versus how the earnings potential for Indian listed corporates. You've also covered quite significantly on valuation, which continues to be a source of discomfort for foreign investors and some domestic investors, as well as you've also highlighted some pockets of risks, whether it is elections, geopolitics, or macroeconomic slowdown in major economies. Now, quite a few questions. First, since the topic of today's webinar is how should you position your investments, given that we may see some of the risks play out at some point later in the year, what would be your a go-to approach for planning your investments, especially for somebody who's already invested? And given that risk assets have done well, there is every possibility that one's asset allocation would have got skewed more towards equities or risk assets, as we call it. So, how do we start from there?
And again, I think the team at Stanchart and your relationship manager will be best placed to look at your asset allocation. But my general rule of thumb is, if you think you are significantly over allocated into risk assets, then it may well not be a bad time to be taking some risk off the table. Now, how do you reduce the risk of your portfolio? It need not mean a complete exit from the market, but if you're, let's say, sitting in some small cap funds, maybe you want to move to balanced funds or you want to move to large cap funds. That in a way reduces the volatility risk on the downside, but still allows you to participate in the equity market. One thing I do want to still maintain to you is that it's not that market valuations are crazily high. We are at 18, 19 average. We are currently at 21. So it's about 10%, 5-10% above. Averages, typically, I think we start becoming uncomfortable with valuation if the valuation goes up, let's say 40-50% above average of the market, because markets gyrate a lot. So I would be uncomfortable on broader equity market or on Nifty if the valuations were like 27 times, 28 times types. Because 28 to 35, 40, we don't see market sustaining. Similarly, at around 12, 13, we find market becoming extremely lucrative. We are somewhere in between. So no major worries, nothing that suggests that you have to sit out of the market completely. But if you are in a very high risk asset class, or if you're over allocated, take some money off the table. Also, in terms of the fresh allocations, maybe consider large caps and balance advantage fund categories, where automatically the portfolio manager will keep on moving your money into equity, which is the risk asset class versus other asset classes, as and when the market situation pans out. So those are the pockets where you can sit with a relatively lesser worry about the volatility.
Thank you, sir. You mentioned about how to position within overall asset allocation and also how to position within equities, so where you see lower risk at the current moment. What about fixed income? Where are the areas? What are the areas of opportunity within the fixed income allocation?
Sure. So fixed income, I think there are two pockets of opportunities. One, of course, as I would say, is that this is a time where you should take some duration bets. See, the key difference between taking a bank deposit versus a mutual fund is In a bank deposit, you are putting your money for 1 year, you earn interest for 1 year. You could actually put money in for 1 year in a debt mutual fund with a maturity of 3 years. So you not only get your accrual, but you also get some benefit from the rate decline as it happens. So this is a time to make some positive ALM mismatch in your portfolio as a strategy. So if you have a time horizon of, let's say, 12 to 18 months, maybe you can consider a short maturity fund, which has a typical maturity of 2 to 3 years, and therefore get some advantage by rate decline. Similarly, if your time horizon is slightly longer, maybe you can consider a gilt fund, corporate bond fund, which will have a 3 to 5, 6 years maturity or 10-year maturity. So take some amount of maturity mismatch is one advice that I would have. But that I would say you should consider only if you have a slightly, let's say, 1 year type of a horizon for other funds. Other opportunity that has actually come out quite well for investors is something called arbitrage fund. While it gets classified as equity, the fund essentially operates like a fixed income fund. This is a fund which basically works on the spread between spot equity in the future, which is nothing but interest rate embedded for equity positioning. And this category of funds have generally been able to deliver you about 7% thereabout return over the last year with a significantly lower taxation because it gets taxed like equity. So you're getting returns in line with debt, but your taxation is more like equity, which means lower taxation. And therefore, your tax-free return on this product will tend to be more like close to 6% tax-free, between 5.5% to 6% tax-free, which is pretty attractive in today's environment. And if you were to do a reverse, calculation of it, it's equivalent to about 9% pre-tax return on a full tax basis. So arbitrage fund for short-term deployment and let's say bond funds, short maturity corporate bond or gilt fund for slightly longer term deployment in debt.
Thank you, sir. Another couple of questions are more directed towards how does one allocate if one was a new investor? Let's say he was just started to get some formal employment, has some cash flow, looks at regular expenses, but has some savings. How does one start? And along with that, there's another question on somebody who's now retired and is expecting his retirement proceeds to come. Obviously, it's going to be all cash because it's a proceed of his retirement corpus. How does one allocate now if he's an income-oriented or income-seeking investor?
Sure. So for both, I think for somebody who's starting now, I think it's a great time to be starting, frankly, because your options of investments are many more than, let's say, they were when I started back about 25, 30 years ago. So at 25, 30 years back, I started generally, and at that point of time, the products for consideration used to be PPF and stuff like that. I wish I started a mutual fund SIP then, but I took it maybe about 7, 8 years later, sometime around 99, 2000 thereabout, but that has done quite well. So I would say for somebody who's starting now, do consider starting some SIPs on a regular basis, and it would do you well over a period of time. So I think that's a fantastic investment to accumulate and build wealth over a period of time. Any SIPs that people have run for 10 year, 15 year, 20 year in the country, you'll find that the return would generally tend to be around anywhere between 13, 14% to 18, 20%. So nothing else compounds your money at that rate. Pick a good fund and start your SIPs. But for somebody who's retiring, my suggestion would be that do allocate a meaningful part of your corpus to a category called Balance Advantage Fund, which is not necessarily a high risk category. It's a lower risk category than pure equity, and yet it becomes tax efficient. What you should do is you should put money there and start withdrawing money through something called a systematic withdrawal plan, where you can get whatever is the monthly expenses that you have, you start withdrawing it from the balance advantage fund that you have made. So ideally keep a 1 year period of wait so that you don't incur an exit load and then start withdrawing. The beauty of this plan in terms of the withdrawal tends to be that when you withdraw your money, your effective tax rate is extremely low because some part of the money that you withdraw gets taxed as principal withdrawal and not as gain. So it's a very, very tax efficient vehicle which allows bulk of the money to get accumulated and to earn higher rate of return, and at the same time give you regularity of cash flow coming to you.
Thank you, sir. The next couple of questions are more on what are some of the satellite opportunistic ideas while we're talking about risks, it's also a time where we think that there is some amount of opportunity. So some opportunistic ideas along with some portfolio hedges, like some of what are some of the investments which can act as good portfolio hedge or diversification tools. So what are these two allocations that you suggest?
Sure. So there could be a couple of topics that come to my mind. One could be, of course, I think StanChart folks will probably have some PMS or AI that they could show to you. I'm not an expert on it, so I'll keep out of it. But the one that comes to my mind would be something like REIT and InvIT. That's an asset class which is probably not as well understood in the market and yet available at a fairly attractive level. So you have a few listed REITs which are all available at a discount to their NAV, and the discounts range to be somewhere between 15-20% or what as high as 30% in a few cases. And some of these listed REITs give you distribution of about 7% per annum in terms of their payout, and also have a scope for capital appreciation. And they're all listed, and therefore you could trade in and out of them. So that's something that they can consult you and choose what works for them. There are also some InvITs which are listed. There is also some InvITs which are coming out with public issues on a regular basis. And those are the ones where you can kind of think about investing. The return expectation from this asset class tends to be somewhere between 10% thereabout. Now, am I audible, Ravi? Sorry, Ravi, are you able to hear me?
Yeah. There was some technical glitch. Yeah. Now, there's a comment on the chat box that I'm being very picky, but there are certain questions that is beyond the scope of this webinar, so we can't take it. But I'm trying to club most of the question together so that it reaches a broader audience. There is a lot of question on India being advancing to a more mature market. Like as the Indian economy grows, it migrates to becoming more informationally efficient market, where fund managers may struggle to generate alpha. So the question follows whether active funds make sense, or you should just be allocated to index funds. So there is this active versus passive. And a related question is whether mutual funds are the right vehicle to implement or play your asset class.
Sure. So unfortunately, I don't have a slide handy with me, but I can tell you that active funds are performing well in India. Active investing is not dead, and it actually outperforms across. So if you really look at even the large cap category, where a lot of people believe that why should I allocate money to large cap and I can just put money into Nifty 50? I'm happy to tell you that a number of well-managed large cap have outperformed Nifty by a very wide margin, including ours. And I'm sure StanChart team would be able to share that with you. So even in a category as concentrated as large cap, where essentially there's only 50 stocks in Nifty and about 100 overall, the fund managers have done an incredible job of outperforming on a regular plan with about 200 basis point plus on a consistent manner. So active investing in India is yet pretty attractive and pretty active. And why does it happen? Let me spend a moment on it. See, India is a very large, liquid, diversified market. Top 3 sectors in the country, aggregate weight of them in India is the lowest among all major markets because we are a very diversified market. As I told you, in US, if 6 companies explained 70% of the market return out of S&P 500, you are doomed as a portfolio manager if you were not invested in those 6 companies. In India, it is not like that. There is not a single sector which can explain more than 10-15% of the market movement. And therefore, we are very diversified. And therefore, active managers who take bet on multiple sectors and try to pick winners within that generally end up working well. Of course, you have 1 year here and there when they might have underperformed, but you look at the track record of people over a long period of time, as well as over a period of last 3-5 years. Active investing, in fact, in calendar 23, most of the active managers have outperformed. Over the last 3 and 5 years, again, they've outperformed. If you look at last 20 years, the outperformance will be huge. So active investing is very much there. Is mutual fund the right vehicle? I leave it to everybody in terms of what works for them. The advantage that mutual fund brings to you is a diversified basket available at the lowest cost possible in the world and in a very tax efficient manner. If you were to go to PMS and AIF, you pay taxes on every single transaction that is undertaken. And therefore, if I were to do mental maths, I think you end up paying more to the government of India by way of taxes. You end up paying a lot more to the manager for the management fee and carry, and which all comes out of your return. And on an average, there's a study available which says that on an average, the PMS and AIFs have not really outperformed the mutual fund averages. There will be a few exceptions here and there, and again, here the choice has to be made more on a satellite approach, where there is some theme that you believe is very strong and you find a resonance in it. You want to allocate a small amount of money, that's something that you can probably think of. But a larger part or the mainstay, I would imagine, should remain in more diversified, tax efficient and convenient vehicles like mutual funds.
Thank you, sir. Another few questions more directed towards the risk in the system. Quite a few investors who've logged in have highlighted that there are during the P500 or Nifty or Indian markets have a very a low probability of a very high correction. Do you see that sort of risk playing out? And if so, if there is a remote chance, how do we position for that?
Sure. So I think I have to be very clear here. The risks are usually not what is known to us. In fact, in this entire universe, we are very small players, and what happens on due to COVID or due to some war is something which is beyond our capability to plan or anticipate. The known risks are not so damaging. The known risk of, let's say, earnings slowdown or global slowdown, or those things don't really matter. On that, the markets don't crash. The crash usually happens from something which you are not able to anticipate, because that works like a shock to the system. Otherwise, in terms of the slowdown of earning and this and that, the market generally well prepared. So, are there any of those risks? There can probably be, and they are probably going to be all the time. You can't enter or exit waiting for whether a COVID will happen this year or not. So, I think what we tend to do, therefore, is we tend to invest in BAU manner, keeping aside some allowance or some cash for an emergency fund or for meeting some eventuality, so that we are not completely out of pocket or we are not completely shafted out of the market on our core allocations. So that's why an asset allocation becomes important, which I think your again, friends at Stanchart will help you, where you try and create some amount of emergency corpus, but rest of the money, of course, you should invest. There's a saying that there's a lot more money wasted or lost in waiting for correction than actually in correction. So I think risk would be there. The non-risk are not so damaging. I don't see a big chance of even a small chance from non-factors of a big fall. But there always remains some amount of uncertainty about future, which is beyond any of our imagination. And that's something that I would not be able to rule out at all.
Thank you, sir. Before we close, one final question, and this is more on those asset classes which we don't have too much idea about. We've got Bitcoins, a lot of crypto coins, we have NFTs, we have different sort of private assets that are evolving. What is your advice for investors who have no idea or not too much idea about these, but they still want to participate in these non-traditional assets?
Sure. I think that it's a fairly simple thing. I normally we should stick to our let's say zone of knowledge, zone of conviction. But at the same time, I think we are not the best people. As traditional manager, and at my age, I'm not the best guy to kind of judge the next smart idea, which could be a crypto or something else. So these things we are not the best judge. You should, if you like and want to enjoy the ride, think about it like the money that you want to go to casino with. You want to enjoy the experience, by all means, please take it. But please take it only with that amount of money that you think you're willing to gamble and you're happy to lose. All of us go into casino knowing fully well that we'll probably lose this money, right? But we still go there because we enjoy the atmosphere, we enjoy the fun. So I abhor calling cryptos or bitcoins as investment. I don't think they are investment. If you were to do a DCF and if you were to put them on any financial model, what is the NPV of that asset? You'll definitely come with an absolute zero number. But however, in the meanwhile, there will be a trend there'll be a speculation, there'll be a fun. And for that, do consider it as entertainment more than investment, and take the money that you're willing to be entertained by.
Thank you, Suresh. So I think we've covered almost all the questions that we had. One final question, and Tanvir wants to understand which is a better way, and I'm sure you get this question quite a lot, the debate between direct plan versus regular plan.
Yeah. So more often than not, I do find that the advisors help value in multitude of ways. And the value really comes in at three levels. I think one is understanding your situation and deciding a broader investment plan. See, more often than not, what we end up doing is not taking a holistic approach to our investing. We try and react on one idea or one opportunity, maybe a new fund offering here or new fund offering there, or some tip from somebody, rather than looking at a holistic picture of what is my total asset base, how much I want to put here, what is the goal that I'm saving for. And that, I think, is a very important element that's underappreciated by a lot of people, and which is where the financial plan, asset allocation comes into play, which is where I see a huge value that advisors bring, and therefore regular plan through advisor, in fact, allows you to understand yourself better, your finances, your goals better, and create a plan for you. Second thing also, I think the fact that all of us are experts in our own fields. You may be a doctor, you may be a lawyer, and you have really done a lot of work to be where you are. Today, I don't self-medicate myself by Googling about a particular disease and the symptoms of it. I go to a doctor knowing fully well, even if I Google, I'll probably find something which may work, 60% of the time. But do I want to take chances with my health? Hell no. So you better trust an expert who has a wider knowledge or a wider access to information compared to you individually. And for that, if the expert is charging me a fee or if the doctor is charging me a fee, it's okay. I can also open the law book and read a law. But I would yet go to a lawyer because he understands the stuff far better. He's dealt with that situation a lot more than I do. So my belief is, and indeed, despite I being here in the position that I am, I still use an advisor because, simply put, I don't think I have enough time on my hand to be able to go through various investment options. So my suggestion would be that do consult your advisor and also be transparent with them. So it's not only about what they are telling you, but you also be a little more open to them and say that this is what my overall assets are and this is what I'm looking to do. And let them devise a holistic plan and determine your asset allocation. That, I think, will be a lot better for you. More often than not, we are happy about a small stock position that we bought, which has gone 50%, but we bought only 1% of it. So, right asset allocation essentially makes a huge difference.
We've on popular demand, a question has kept coming, though we've answered that. Divided in two parts. Large cap.
Want to invest, but still figuring out how to start, where to invest, or whose guidance to follow? How about an investment tool that brings together industry-leading solutions in one place? Presenting Standard Chartered Invest, your one-stop online investment shop. What does it do for you? Well, for starters, there's no paperwork to open an investment account. And if you're confused about where to start investing, just tap to view our pre-generated SIP packs based on your risk appetite. Not just that, you can get theme-based fund ideas too, as per your investment needs. With comprehensive market insights at your fingertips, now you can easily keep track of the markets and get access to detailed reports, so that you can make informed investment decisions, monitor the performance of your investments, and realign them as per your convenience. And no matter where you are, transact on the go while having complete control of your investments in your hands. View all your holdings, buy new funds, and do a lot more with your SIPs too. You can pause or cancel your SIPs whenever you want, or resume as well as redeem them anytime as per your wish. All this and a host of other benefits just waiting for you to explore on SC Invest. Get set, invest today. Simply log into online banking or the SC mobile app. Download now.